Today we are driving into moving averages. Yes, this indicator is really old and many younger traders might ask, is it still really relevant? Because, well, it has been here for generations. It's really simple and wouldn't anyone have actually cracked way how it works, so it's no longer effective? Well, here's the thing. The very fact that it is so old means that it is deadly effective rather than old. But only, of course, as it is with any indicators, if you can use it correctly and if you actually understand how this works. And luckily for you, this video will explore you just that. So let's roll. First things first, moving average. As it is with almost any kind of trading indicator, name already implies its meaning and how it works. And here, its works are simple. It's calculated on average price of specific time period. So if someone says 200-day moving average, that will imply that moving average will be at the level of previous 200-day average prices. This is how it's created, nothing fancy. And paradoxical situation is that simpleness makes it so goddamn effective. Now, actually, of course, there are a few ways how you can actually adjust it, and there are several moving averages. There is regular moving average, there is exponential moving average, there is moving average ribbon, and there are many indicators which are based on moving average, such as Bollinger Bands, which effectively is variation of moving averages, and you could use it almost in identical ways as moving averages. And there is, for instance, indicators such as MACD, which is, I would say, combination of different period moving averages, and you could actually combine these moving averages and adjust them in the way you fit. And there are a lot of software engineers who could actually give you custom-made moving averages. Just see TradingView or MetaTrader website and you will see that for yourself. But that's actually not necessary, because in my experience, moving average works best if it has the simplest and most robust approaches. And now let's explain these approaches. Firstly, if you use moving average, use only one type of moving average. I personally use exponential moving average because it's created in the way that it slightly more looks at last time periods rather than simply average price. Because if you have that example of 200-day moving average, regular moving average will weigh all days equally. So the first or second day 200 days ago will have the same weight as last 2 days. But of course, you know that trading dynamics are slightly more relevant when they are newer. So exponential moving average takes in consideration that one. So it has slightly more emphasis on those last dates and last prices. So for me, it's slightly more practical. So that's the thing. Use only one. And remember all of the time, if price trends will be strong, all the moving averages will be showing you more or less the same trend. And if they will be weak, they wouldn't be showing you any meaningful trends at all. That's the most important thing to remember. So that means once you have chosen your moving average, second is try to have optimal time frame of that moving average. That means whether you will be using it for trading analysis, short-term trading, or long-term investing. Because here's the thing, you actually could use it as an analytical tool. For instance, if you're watching a long-term crypto market or long-term stock market in daily or weekly charts, you could use like 200-day moving average and it will show you how long-term trends actually looks. And actually, you could use it for the trading for the identical purposes. So that means it's not only analytical tool, but you could actually have precise ways how you could actually use it. If prices are above moving average, you buy. When prices are below moving average, you sell. And variations of these kinds of approach. So this is second practical approach, but you have to choose whether you will use it as analyst or as a trader. For analyst, it's simpler because you could actually stack different moving average levels and different time frames with different markets and just see whether you have some pattern. But here also, I would say that it works best if you use it really simply. Like the classical example, 200-day moving average in daily market, and you will see what are the long-term stock market trends. Simple, clean, deadly effective. Now, as a trader, things might go slightly more complicated, because as a trader, you have to actually test these ideas. You simply cannot look at them and think, yes, it might look well, so that means pattern is bearish. You have to see how it performs, and you have to see what's the best way for your trading. For instance, you might use 30-minute chart on the same example of stock indices, and you could have like 20 moving average, or you could have 200 moving average. That will significantly determine the number of trades you take and number of trades you will see, because one approach is for longer term trends, other approach is for shorter term swing trading. So there is actually no right or wrong answer, but you have to simply test which works for you and which you could actually trade at it. So here nuances are far more important, but the thing also here is do not use many moving averages, do not use many time period moving averages. They just stick to one simple way which shows you direction of trend and leave it there. It will work well because in any case it will give you opportunity to make money on all most important market moves. But before we continue, here's the thing: to see how this is done properly, you will have to have lots of trading examples and trade analysis and actual strategies which are based on price action and moving averages. And for that, I strongly suggest you to watch other videos about moving averages and most importantly, join my Telegram channel, because there you will have trading strategies and trading signals which are based on this approach. And all of that is free. So all you have to do is simply join my link below the video and you are into my Telegram channel, and effectively that's it. You could start your professional journey from there. So in the last section of this video, let's have some practical ideas how you could actually work with that. Firstly, you could use it as a general setting for general market trends, as I told you in my previous example, so you could see whether the markets are bullish or bearish. Then secondly, if you use it as a trader, you could actually narrow down your time frame and use it in, for instance, hourly or 4-hour charts and trade from these time frames, because you will have way more trading opportunities. So go to that slightly shorter time frame and then see what are the moving averages saying you. So even if you want to trade on slightly shorter trends, not long-term trends which goes for years, but those who goes for weeks, then adjust that moving average from 200 to, let's say, 50. And if you have 1-hour chart with 50 moving average, you will have from one side plenty of opportunities, and from other side you will have ability to still make money on those sharp, strong moves. So simply then use moving average as indicator for opening and closing your trades. For instance, if general pattern is bullish with long-term view and in short-term view you want to trade, so that means you are trading long only. You will go long when prices are above moving average and put stop loss below moving average, and simply go long when prices are going that upwards move. Or in reverse, if your long-term view is bearish and you are trading short only, that means go short when prices are closing below moving average, put stop loss above it, and simply go with the trend line. Here, as it is always with trading, as I'm always emphasizing in trading, key thing here is to have good risk management, stop loss orders, and risk reward per your trades, because the biggest drawback of moving averages is that if you trade this strategy, for most of the time it wouldn't work. So that means out of 5 trades, you'll be lucky that you will make money in the one trade. But if you are correct, that one trade could be 10 or 20 times larger than those 4 losses. And that's where magic happens. And that's where moving average truly shines, and this strategy actually have made the most money for the most successful traders for decades, because this is the way how you could actually buy stock at 10 and sell it at 200. This is the way how you could actually buy Bitcoin at 16,000 and sell it at 80,000. And this is how you could actually short oil from $120 to $40 by following long-term moving averages and watching your risk management very, very thoroughly. And if you want to see how this is done, watch my practical video about moving averages and join my Telegram channel, because there you will see the real deal. So thanks for watching, and let's meet later.